You don't have to chase the noise, we already did. We read the data, we watch the movements, we trace the patterns behind every headline. What you get here isn't just information, it's clarity. You don't have to scroll endlessly or compare 1,000 opinions. We do the digging. We face the chaos. We bring you what matters. All you need to do is listen. Bitcoin didn't weaken this week. It sorted people. Tonight, our cover is simple on the surface. When miners become data centers, what do they know? And the headline underneath it is even sharper. Cipher Digital changes its name while it steps away from pure Bitcoin mining and leans into high-performance computing, long leases, huge power contracts, and a different kind of certainty. And while companies rewrite their business models, something quieter happens on-chain. More than 400,000 coins moved into the 60 to 70,000 range. Not opinions, not narratives. Commitments, not narratives. So you and I are going to watch the same market from two angles. The boardroom chasing stable cash flows and the crowd choosing a price band and refusing to let go. And if you listen closely, you'll notice what nobody says out loud. Who is buying time? And who is selling it? Cipher Digital renames itself while it walks away from Bitcoin mining toward high-performance computing. You can watch a company change its name and call it strategy, or you can watch the incentives underneath it shift and realize the name was just catching up. Here the numbers missed expectations, but the real story is about what kind of business Cipher is choosing to become. You see the tension immediately, don't you? A firm built in the honest brutality of Bitcoin mining now wants the long contracts and predictable cash flows of high-performance computing. And the market responds the only way it can when certainty is promised, but not yet delivered. It marks the shares down. Cipher Digital, previously known as Cipher Mining, saw its shares slide by about 5% before the market opened, after reporting a fourth quarter that disappointed the people who measure reality by estimates. But we should slow down here because estimates are not truth. They are expectations. And expectations are just crowded beliefs. Revenue came in at about $60 million, below the roughly $84.4 million analysts anticipated. Adjusted earnings per share showed a loss of about $0.14, wider than the expected loss of about $0.06. The quarter carried an adjusted net loss of about $55 million. So yes, the scoreboard looked ugly. But why would management accept that kind of ugliness in public? Because they are trying to trade one form of uncertainty for another. Bitcoin mining is exposure to an open battlefield. Price, difficulty, energy, competition, and the constant pressure to stay efficient. High-performance computing data centers are a different kind of wager. Long build cycles, heavy financing, and customers who demand reliability more than heroism. Here is the first micro hook. What does a miner do when the market stops paying for raw exposure and starts paying for dependable infrastructure? Management framed the year 2025 as transformative, which is a careful word. It means they want you to think in timelines, not quarters. They are leaning into long-term high-performance computing capacity, and they pointed to contracted power and leases as the new foundation under their feet. During the quarter, Cipher secured about 600 megawatts of contracted capacity. The centerpiece was a 15-year lease for about 300 megawatts with Amazon Web Services, paired with a 10-year lease for about 300 megawatts tied to FluidStack and Google. Notice what is happening. They are replacing the volatility of mining revenue with the discipline of counterparties and contracts. Second micro hook. When a business moves from chasing blocks to selling time, are they becoming safer or just becoming slower? To build this new identity, Cipher raised about $3.73 billion through 3 senior secured bond offerings. That money is meant to finance construction at the Barber Lake and Black Pearl data center projects, which the company says remain on schedule, and this is where the praxeology becomes clear. Debt is not just capital. Debt is a promise about the future, signed in the present. They also sold their 49% stakes in 3 mining joint ventures for about $40 million in stock, simplifying the structure as they transition toward a data center-focused model. Less sprawl, less distraction. Cleaner story for lenders and customers. And still, the shares fell. Because the market is not punishing the idea. It is pricing the gap between intention and arrival. A rebrand cannot do the work of execution, and a contract cannot erase construction risk. What you are watching is a firm stepping away from the harsh transparency of Bitcoin mining into the managed world of enterprise infrastructure, where predictability is purchased with leverage and long commitments. If you sit with this for a moment, you may feel the deeper question forming on its own. Are we witnessing progress, or just a different way of postponing uncertainty? We are Blocksonic. We do not predict the market. We read its memory. And the memory here is simple. Names change when incentives have already moved. What matters is whether the new promises will hold when reality stops being patient. If you feel that tension too, you already know what is worth discussing next. In Bitcoin's drop, 400,000 coins chose the $60,000 to $70,000 line. You feel it when a market falls. Panic above, silence in the middle, and then a strange kind of conviction below. We are going to trace that conviction because on-chain data shows a heavy migration of ownership into the $60,000 to $70,000 zone after the latest drawdown. A sell-off always looks like weakness from far away. Up close, it is a sorting process. During this latest downturn, more than 400,000 Bitcoin were accumulated between $60,000 and $70,000. Not traded, not admired from a distance, absorbed. And that detail matters because accumulation is a form of speech. It tells you where some people stopped asking for permission from price. Glassnode's data shows the supply in that band rising from roughly 997,000 Bitcoin on January 1st to about 1,430,000 Bitcoin today. That is an increase of approximately 429,000 Bitcoin, around 43%. In other words, a dense pocket of ownership formed right where fear expected emptiness. Here's the quiet implication. More than 8% of the non-exchange circulating supply now carries its cost basis inside that range. So when you look at that zone, you are not just seeing a number on a chart. You are seeing a crowd of decisions, each one made under uncertainty, each one choosing to hold. And what was price doing while this was happening? It fell from around $88,000 on January 1st to about $63,000. Zoom out one more layer and you see the larger confession. Bitcoin dropped roughly 50% from its October all-time high of $126,000. The market did what markets do. It tested belief with pain. But how do we know these coins were truly positioned there rather than merely shuffled around? This is where the method matters. Glassnode uses what it calls the unspent transaction, output realized price distribution metric, grouping existing supply by the price at which each coin last moved on-chain. The entity-adjusted version goes further. Clustering addresses likely controlled by the same owner, excluding internal transfers and removing exchange balances. The goal is simple. Strip away the noise and get closer to genuine cost basis. Ask yourself this, and be honest. When price falls, are you watching candles or watching ownership change hands? Now notice the contrast the market revealed on the way down. The $70,000 to $80,000 region has been described as an air pocket. a zone where Bitcoin historically traded very little. Thin participation leaves thin support. And during this decline, it took only 5 days from January 31st to February 5th for Bitcoin to fall from $80,000 to $70,000. Price did not negotiate there. It passed through. Second micro hook, because it matters. What looks like support is often just memory. What looks like empty space is often just the absence of past agreement. So the market fell quickly through the lightly owned zone and then slowed where ownership thickened low. That is not mysticism. That is coordination. When fewer people have history at a price, fewer people defend it. When many people have cost basis at a level, selling becomes a different psychological act. Because selling there would mean selling into one's own declared conviction. We are not predicting what comes next. We are reading what already happened. A redistribution of Bitcoin toward those willing to buy when the story felt worst. And if you sit with this long enough, you may notice something uncomfortable and clarifying. Volatility is not the enemy of truth. It is the mechanism that forces truth out of hiding. If this lens helps you see the market as human action instead of random motion, keep it close. Because the next time price moves fast through an empty zone, you will recognize what it really is. Not chaos, but the absence of prior commitment. We are blocksonic. We don't predict the market. We read its memory. And the question we leave you with is simple. When the chart goes quiet, do you see fear? Or do you see decisions settling into place? You don't have to chase the noise. We already did. We read the data. We watch the movements. We trace the patterns behind every headline. What you get here isn't just information. It's clarity. You don't have to scroll endlessly or compare 1,000 opinions. We do the digging. We face the chaos. We bring you what matters. All you need to do is listen. Bitcoin hovers near $63,000 as Pippin's surge confesses the froth. Your day ahead for February 24th, 2026, seen through the simple lens of human action. When Bitcoin weakens and attention still chases novelty, the market is not calming down. It is relocating its appetite. And that relocation tells us what pain might still be unpaid. You feel the contradiction immediately, don't you? Bitcoin slips, discipline is tested, and yet a fresh token can still ignite as if gravity was optional. Right now, Bitcoin sits near $63,000, heavy in its movement, with other major tokens leaning the same way. But the spotlight has wandered, not to productivity, not to savings, to a story. Pippin is that story. It began as a generated unicorn image, then grew into an autonomous artificial intelligence agent that performs on social platforms. And now it trades as a memcoin on Solana. Over roughly 4 weeks, it rose by about 135%, and in the last day alone, it climbed another 10%. When you see that while the benchmark asset is struggling, you are watching preference reveal itself, not for utility, but for sensation. Here is our first micro hook. If the market was truly sobering up, would the most explosive bid be flowing into an artificial character with a ticker? A market intelligence firm frames the move as speculation with a warning label. Strong interest, fast growth in market value, and then the darker underside. Concerns about manipulation, about crime, about price being pushed by artificial pumps rather than earned by organic demand. In plain terms, you and I are watching the oldest pattern in finance wearing new clothing. People do not stop gambling because conditions worsen. They often gamble harder because conditions worsen. And then come the allegations. Social accounts claiming the rally is tied to money laundering. Whether those claims are true is almost secondary to what they introduce, reputational risk. Because every time a corner of the ecosystem looks like a laundering machine, the entire ecosystem pays a trust tax, not by decree, by human hesitation. Now let's place that beside Bitcoin's own drawdown. Bitcoin is down almost half from its October levels, and still the froth finds oxygen. That is not a sign of health. It is a sign that liquidation has not finished teaching its lesson. Speculative heat can survive a decline. Sometimes it survives precisely because the decline has not yet reached the people who believed they were immune. Second micro hook. What do you think a bottom is, if not the moment when the market stops rewarding fantasies? One observer put it bluntly. A Bitcoin low may require a cleansing of millions of cryptos that track nothing, and a return of volatility in stocks. Notice the structure of that thought. It is not anti-innovation. It is pro-calculation. When too many assets exist mainly to absorb attention, price discovery becomes fog, and the fog must eventually clear. In the latest session, Bitcoin dipped below $63,000 during Asian hours and then steadied near $63,200. But it was still down about 4% over the day, with Ether, Solana, XRP, and a broad index of major tokens falling at least as much. This is how risk unwinds. Not with a single dramatic snap, but with synchronized reluctance. Why the pressure? Tariffs in the United States, and fear that artificial intelligence-driven disruption will hit growth and jobs. You can call that macro. We call it uncertainty becoming personal. When people cannot map tomorrow's income, they reach for liquidity today. And yet, there is another layer. Institutional demand appears steady in its absence. One metric watches the price difference between a major United States venue and an offshore venue, and it has stayed negative. The meaning is simple. The bid you might expect from large, regulated pools of capital is not arriving with conviction. When that kind of demand is missing, support levels become psychological cliffs instead of engineered floors. So traders keep circling one number, $60,000. Not because it is magical, but because many positions are built as if it cannot break. One investor warned that if Bitcoin loses $60,000, cascading liquidations could turn violent, and any recovery could be delayed until the next halving draws near. He even imagines treasury-style companies tied to Bitcoin and Ether breaking under the strain, with a prominent Bitcoin proxy equity falling sharply if that line fails. Whether his exact scenario happens is less important than the mechanism he points to. Leverage stacked on a shared assumption. When the assumption cracks, everyone discovers they were standing on the same plank. Even traditional markets are whispering to crypto. The yen weakened about 1% against the United States dollar after reports of political pressure against Japan's central bank tightening plans. Recently, the yen and Bitcoin have moved with an uncanny positive relationship. That is not mysticism. That is correlation born from global risk positioning, from crowded trades, from the same hands expressing fear and hope through different instruments. So we end where we began, with that quiet confession. Bitcoin hesitates near $63,000, and a meme coin races upward on narrative fuel. The market is telling you it still wants escape more than it wants truth. If you find yourself replaying that contradiction later, good, because the question is not whether froth exists. The question is what we become when we mistake froth for recovery and call it progress. The iPhone shadow in Bitcoin. Why Michael Saylor sees the same valley of doubt. You and I keep mistaking a drawdown for a verdict, but markets do not issue verdicts. They stage interrogations, and they watch who confesses first. Michael Saylor wants you to hold two images in your mind at once. Not Apple as a polished monument, but Apple as it looked in the year 2013, when its stock had fallen about 45% from its peak and traded at a price-to-earnings ratio below 10. The iPhone was already stitched into daily life for more than 1 billion people, yet the market priced Apple like a tired machine with no next chapter. That is the first lesson, and it is uncomfortable. Usefulness can be obvious and still be underpriced, because price is not a measurement of truth. Price is a measurement of consensus, and consensus moves slowly when uncertainty is expensive. So Saylor reaches for the same pattern and lays it over Bitcoin. He argues that every successful technology investment carries a required toll, a deep correction that forces you to separate conviction from convenience. In his words, there is no real example of a winning technology story where you did not endure the 45% fall and walk through what he calls the valley of despair. Here is the paradox you should notice. If the asset is truly transformative, it must be doubted for longer than feels rational. Because transformation rearranges incentives, and incentives do not surrender without a fight. Saylor points out that Apple did not simply bounce. It took years and it took time for influential capital to publicly align with what consumers already knew. The market needed a bridge between lived reality and financial narrative. Only then did the old valuation return. Now look at Bitcoin through that same lens. Bitcoin has fallen roughly 45% from an all-time high near $125,000. The scale resembles that earlier Apple decline, and the pain is not theoretical. In a single session on February 5th, when Bitcoin slid from $70,000 to $60,000, on-chain data recorded about $3.2 billion in realized losses, the kind of day that leaves a mark on memory. Mid-hook, what does a scar in markets really mean? It means someone was forced to sell not because their belief changed, but because their structure broke. And this is where Saylor shifts from psychology to plumbing. He suggests the cycle looks more muted partly because the machinery around Bitcoin is changing. Derivatives activity, once concentrated in offshore venues, has been migrating toward regulated United States markets. When leverage is pulled into brighter light, volatility can compress in both directions. What might have expressed itself as an 80% collapse in a wilder era may arrive as a 40 to 50% decline instead. But regulation does not erase risk. It relocates it. Traditional banks, he notes, still hesitate to extend meaningful credit against Bitcoin holdings. So some investors reach for substitutes. Shadow lending, rehypothecation, clever structures that promise liquidity while quietly stacking fragility. In stress, those structures can manufacture sell pressure that looks like the market changing its mind, when it is really the margin of safety evaporating. Mid-hook. When you see selling, are you witnessing a change in belief or a liquidation of necessity? Then comes the familiar ritual of fear. Quantum computing appears on the horizon, and critics present it as an existential countdown. Saylor treats this as another turn of an old wheel. New language, same function. He places quantum alongside earlier threats that captured attention for a season block-sized battles, energy panic, mining geography, and says these narratives rarely defeat the network. They mostly test whether you can think in time horizons longer than a headline. His reasoning is straightforward. If quantum becomes credible, it will not target Bitcoin alone. It will pressure every digital system that modern life depends on. Government, finance, consumer, infrastructure, defense. In that world, the migration to post-quantum cryptography becomes a civilization-wide upgrade, not a Bitcoin-specific patch. And if the world is upgrading, Bitcoin can upgrade too through the same mechanism it always uses. Broad, voluntary coordination among nodes, exchanges, and hardware providers. So when the conversation shifts from quantum fear to the next fear, Saylor reads it as what it has always been: uncertainty, searching for a costume. He even frames renewed attention around the Jeffrey Epstein files, used by critics to target certain Bitcoin core developers, as another variation of the same impulse. A story designed to make you associate the tool with the worst possible shadow, So you stop asking what the tool actually does. And that brings us back to the beginning. The valley of despair is not a place where technology fails. It is a place where weak structures fail and where impatient narratives run out of oxygen. If you sit with this long enough, you start to see what Sailor is really offering you. Not a promise, a lens, a way to separate adoption from valuation and usefulness from applause. We can leave one question hanging between us because it is the only one that matters in a drawdown. Are you watching Bitcoin break, or are you watching the crowd discover the price of waiting? If that question stays with you, you will know what part of this was always visible. And if you're here right now, don't just watch. Talk to us in the chat, share what you see, what you feel. The algorithm can't read silence. It only reads movement. Every message, every reaction keeps this current alive. Subscribe, share, and let others join this signal. Together, we turn insight into motion. Crypto markets bleed while Bitcoin waits above the liquidation line. You can feel it when a market stops falling loudly and starts slipping quietly. We are watching Bitcoin hover near a level where fear turns mechanical and selling stops being a choice. Bitcoin has drifted down toward the low $60,000 region as the dollar strengthens and equities lose their footing. The tension is simple. If price breaks beneath $60,000, forced liquidations can cascade, pulling the market toward an older memory around $52,500. And yet, the same weakness that scares people also hints at exhaustion. Bitcoin has now fallen for 4 straight days, settling around $63,100. Not long ago, it touched roughly $60,200. And you can see what the market is doing with that reference point. It is not just trading a price. It is negotiating with a boundary. This drop is arriving alongside a broader shift in mood. When investors turn risk off, they do not announce it with speeches. They rotate. United States equities have slipped this week, and the dollar has climbed by about 0.5% since early Monday in Asian trading hours. That is the quiet signal. Liquidity is being preferred over aspiration. Here is the uncomfortable part you are meant to notice. Bitcoin is down about 2.1% since midnight coordinated universal time and about 4.7% over the past 24 hours. Those are not just numbers. They are footprints of leverage leaving the room. Microhook. What happens when selling is no longer voluntary? If Bitcoin breaks below $60,000, the market may not simply continue downward. It can accelerate, because liquidation is not an opinion, it is a rule. And the next likely magnet becomes $52,500. Not because it is magical, but because it is remembered. It is a historical support area reaching back to 2021, when a different set of hopes and fears first carved that level into collective behavior. The bruising is not isolated to Bitcoin. The altcoin market is absorbing the same message in a harsher dialect. Bitcoin Cash has fallen about 11.5% in the last 24 hours, with an additional drop of roughly 3% since midnight coordinated universal time. Other names like Sui, JUP, Pump, and WFI have each lost more than 2%. In moments like this, you learn which assets were held by conviction and which were held by momentum. Microhook. Why does a slow bleed feel worse than a sudden crash? Analysts call this kind of price action a slow bleed, the sort that has appeared in prior crypto bear markets, and they are pointing to a technical tell. The average crypto relative strength index is flashing oversold. That does not promise a reversal. It only tells you something more subtle, that selling pressure may be tiring, and that a bounce could form in the low $60,000 region, simply because the market has already spent so much energy falling. So we sit with the real lesson. When the dollar strengthens and risk assets weaken, it is not bad luck. It is a repricing of time preference, a collective decision to hold what feels immediately safe. Bitcoin in these moments becomes a mirror. It shows you where leverage was hiding and how quickly confidence can be converted into forced exits. If you find yourself replaying that $60,000 line in your mind, that is not irrational. It is your intuition noticing how markets turn thresholds into events. And then the question that lingers is not whether Bitcoin bounces or breaks. It is this: when the next move comes, will it be chosen by humans or triggered by the machinery they built to avoid uncertainty? Bitcoin price discovery is quietly relocating to Chicago. We can feel the irony forming before we even name it. An asset born to route around old power is now being priced, hedged, and disciplined inside the most familiar rooms of legacy finance. Not because anyone won an argument, but because institutions follow incentives the way water follows gravity. You came to Bitcoin because it did not ask permission. And yet here is the paradox. The more valuable Bitcoin becomes, the more it attracts the kind of capital that refuses to operate without rules, clearing, and known counterpart. Trading in the dominant cryptocurrency is drifting toward Chicago, toward the Chicago Mercantile Exchange Group, and the coming shift to non-stop derivatives access later this year matters more than it first appears. It removes one of the last practical advantages that offshore crypto venues held over regulated markets: continuous access when everyone else is closed. Ask yourself what institutions really buy when they buy exposure. Is it the asset or the ability to control the risk around the asset? Carl Naim, the chief commercial officer at CBCO, points to a simple motive that explains a lot of human action. Traditional hedge fund managers can step deeper into Bitcoin if they can trade instruments they already understand on infrastructure already wired into their systems, without rewriting their technology or relocating their signals. And underneath that is the quiet question every allocator asks before every trade: why accept counterparty risk from an entity you do not know when you can clear through a machine you already trust? The Chicago Mercantile Exchange Group already leads regulated Bitcoin futures by open interest, and its contracts support much of the hedging tied to United States spot exchange-traded funds. But there was a friction point that kept the old world from fully swallowing the new one: weekends. Trading paused, offshore markets kept moving, and the price left behind those familiar gaps that institutions could not respond to until the bell rang again. Now imagine what happens when that pause disappears. Around-the-clock trading means the institution that once tolerated weekend exposure or avoided it entirely can hedge continuously. Arbitrage windows between regulated futures and offshore perpetual swaps tighten. The market becomes less forgiving to anyone relying on time zones as an edge. And here is the second hook, the one most people miss: when non-stop access becomes available inside the regulated venue. What reason remains for a large allocator to keep meaningful exposure on a crypto exchange just to stay awake on weekends? For the institutions that prioritize regulatory clarity and established clearinghouses, the Chicago Mercantile Exchange Group starts to look less like an option and more like the default setting. Not because it is more innovative, but because it is more legible to the committees that must explain risk to other committees. Even the crypto exchanges can see the direction of travel. In January, the president of OKX, Hong Fang, argued that crypto derivatives could one day rival or surpass spot volumes on major global exchanges, and that regulated volatility markets in the United States could become an even stronger anchor for Bitcoin price discovery worldwide. Read that slowly. It is not a prediction about technology. It is a recognition about where liquidity prefers to gather when the stakes grow heavy. Naim frames it as an evolution in how capital enters Bitcoin. What began as grassroots activism, retail traders reaching for an alternative to Wall Street, has inverted. Now the institutions are increasingly the ones shaping the marginal trade, and the marginal trade is what moves price in the short run. So the conversation changes. Instead of asking what Bitcoin means, they ask how Bitcoin behaves in a portfolio. When institutional positioning carries more weight, Bitcoin's near-term direction starts reflecting global risk sentiment. Naim gives a blunt example. If the United States were to attack Iran in a way that implies forced regime change, markets would likely move into risk-off behavior. Gold would rally, equities would fall, and Bitcoin would fall with them. Not because Bitcoin failed, but because leveraged humans do risk together when uncertainty spikes. In that framework, Bitcoin becomes less of a standalone crypto story and more of a macro instrument priced alongside equities and commodities rather than apart from them. The same hands that reweight exposure across risk assets reweight Bitcoin too, because their mandate is not ideological purity. Their mandate is survival, return, and explainability. Naim admits the irony in plain words. Bitcoin was about decentralization. And yet we can see the mechanism that pulls in the opposite direction. As institutional capital scales, liquidity consolidates where the rails are strongest. Regulated clearinghouses, familiar legal structures, counterparties with reputations that can be sued. Institutional money does not chase risky platforms. It chases risk assets packaged inside platforms that feel boring enough to trust. So we end up here with a quiet relocation of influence, not a conspiracy, not a betrayal. Just incentives doing what incentives always do. If you sit with this for a moment, you may notice a question forming that does not have a comfortable answer. When Bitcoin's truth is priced inside the old world's machinery, what exactly remains decentralized? And what merely remains outside our attention until it matters? And if you're here right now, don't just watch. Talk to us in the chat. Share what you see, what you feel. The algorithm can't read silence. It only reads movement. Every message, every reaction keeps this current alive. Subscribe, share, and let others join this signal. Together, we turn insight into motion. When fear of artificial intelligence meets crypto weakness, losses spread through Ethereum, Solana, and XRP. You can feel it when a market stops arguing and starts hesitating. We are watching that hesitation spread from technology stocks into crypto, where weakness that began inside the ecosystem is now being pressed down by a broader risk retreat. And when Bitcoin cannot climb out of its own range, the rest of the market starts to confess what it was leaning on. The strange part is this: nothing is breaking, yet everything is bending. Majors across crypto have been posting weekly losses in the high single digits to low double digits, and the mood underneath those moves is not panic. It is fatigue, the kind that appears when buyers step back and sellers do not need to rush. Bitcoin slid to around $62,900 on Tuesday, down about 2.1% on the day and 7.5% on the week. But the more revealing detail is not the drop itself. It is the shape of it. A grinding decline that refuses to give you the clean drama of a breakdown or the relief of a sharp bounce. And that is how a range becomes a trap. Price has kept the market boxed inside the $60,000 to $70,000 band that formed after the February 5th flush. At first, ranges feel like stability. Later, you realize they can be postponement. A holding pattern waiting for the one piece of information strong enough to force everyone to choose. Here is the first micro hook. What if the market is not searching for a bottom, but for permission? Altcoins are absorbing the heavier weight. Ethereum traded near $1,800, down 8% on the week. XRP fell about 10.8%. Solana shed around 11.3%. Dogecoin dropped close to 10%. You can read this as simple volatility, but we should read it as shrinking risk appetite concentrating toward Bitcoin, and even that bid thinning at the edges. When capital becomes cautious, it does not disappear evenly. It retreats to what feels most liquid, most defensible, most socially acceptable to hold. That is why the underperformance across majors matters. It is not just price. It is preference. CryptoQuant pointed to sell-side pressure among altcoins at 5-year highs, implying holders are distributing into a market where buyers are scarce outside the largest capitalization. This is not the cinematic kind of selling that prints giant liquidation candles and invites heroic dip buying. This is structural, quiet, a slow transfer from impatient hands to no hands at all. Second micro hook. Have you noticed how the hardest markets are the ones that fall without giving you a story? One analyst, Alex Kupsikevich of FXPO, framed Bitcoin's recent attempt at recovery as consolidation rather than reversal. In other words, the market is not healing, it is pausing. He described a bearish pennant on the daily chart, where a move below the mid-$65,000 area would suggest continuation lower, while a break above $70,000 would invalidate that bearish structure. But the deeper signal is historical, not just technical. That $60,000 to $70,000 zone once acted as the ceiling for the entire 2021 cycle. Now it behaves like contested ground, where long-term accumulators and newer holders meet each other with different time horizons and different levels of pain tolerance. One side can wait, the other side needs relief. The other side needs relief. And then the outside world leans in. A Citrini research report highlighted an emerging artificial intelligence scare trade, warning of disruption across delivery, payments, and software. When investors begin to question which businesses are helped by artificial intelligence and which are threatened by it, they start repricing the future. That repricing hits tech-adjacent equities first, but it does not stay there, because the same pool of risk capital funds the same kinds of narrative. Crypto does not always move in lockstep with equities. You already know that. But it drinks from the same liquidity well, and it responds to the same repositioning when the crowd shifts from expansion to defense. When the mood turns risk-off, correlation is not a rule. It is a consequence. Bitcoin is now roughly 48% below its October all-time high and about 5.5% below its 2021 peak, near $69,000. The longer it remains trapped in this band without reclaiming higher ground, the more the technical picture tilts toward the bears, not because bears are stronger, but because indecision eventually becomes a decision. So we sit with the real question, not whether Bitcoin breaks $60,000 or clears $70,000, but what kind of market we are building when uncertainty spreads from machines that can think into humans who no longer want to risk being wrong. If this tension you feel has a name in your mind, hold it there for a moment. Let it sharpen. Because sometimes the market is not moving toward a price. It is moving toward a truth you were already sensing. And the only thing left is to ask, when the catalyst arrives, which side of your own time preference will it expose? Bitcoin slips beneath $63,000, and the chart whispers that the bottom usually comes later. Bitcoin is not falling in a vacuum, you can feel that. It is absorbing the same uncertainty moving through stocks, tariffs, geopolitics, and a sudden doubt about the stories investors were using to justify risk. You see the paradox, don't you? The very moment people demand certainty, they trade the most uncertain thing they own. During Asian trading hours, Bitcoin slid beneath $63,000, extending weakness that began overnight. And the reason is never just the number on the screen. It is the mood behind it. renewed tariff fears tied to President Donald Trump, and a broader nervousness as the artificial intelligence trade stops feeling like a guaranteed future and starts feeling like a crowded door. Zoom out for a breath, and the week already carries a clear confession. Bitcoin is down close to 7%, back near levels last seen around February 6th, when price nearly fell to $60,000. Not because the network changed, because the people changed their posture. One market participant framed it the way humans always do when uncertainty returns. Bitcoin pulled back sharply, much like equities, with tariff-related doubt resurfacing in a way that rhymes with April of 2025. Add rising geopolitical tension, and you get a short-term bias towards selling first and asking questions later. This is not prophecy. It is pattern recognition in human action. Here's the first hinge point you should watch, not because it is magical, but because crowds coordinate around simple landmarks. $60,000. Bulls stare at it the way a tired traveler stares at a bridge in the fog. If it holds, confidence survives another day. If it breaks, the mind immediately reaches for the next plausible shelf, and talk drifts toward the mid to low $50,000 range. Ask yourself a sharper question. When tariffs shift by a few percent, why does Bitcoin move as if the ground itself changed? Because tariffs are not just policy. They are a signal that rules can be rewritten mid-game. United States stocks fell after Trump said he would impose temporary 15% tariffs on imports, higher than the 10% rate announced days earlier, after a Supreme Court decision struck down his earlier tariff strategy. At the same time, investors kept selling companies that were supposed to win the artificial intelligence revolution, as if the future itself had missed earnings. Mid-hook. What looks like a Bitcoin story is often a liquidity story wearing a Bitcoin mask. Now we reach the part where many people cling to history the way they cling to railings on a moving ship. There is a long-observed pattern. Bitcoin rarely forms a major bottom until a shorter-term moving average, the 50-week average price, crosses below the 100-week average price. This so-called bear cross appeared near the end of prior deep bear markets, including those around 2022 and 2018. But notice what that implies. Today, we are nowhere near that condition. The 50-week average remains well above the 100-week average. If you treat the past as a map, then the road could still slope downward, perhaps toward $50,000 or lower, before those averages ever meet, and the market finally exhausts the last sellers. Mid-hook. Why would a bearish cross be associated with a bottom at all? Because moving averages are slow. They do not lead the market, they trail it. Crossovers are not crystal balls, they are receipts. By the time the shorter average sinks under the longer one, the damage has usually already been done. The optimism already spent. And the remaining holders are the ones with lower time preference and stronger hands. The signal does not cause capitulation. It tends to confirm that capitulation has already visited. And yet we stay honest. No indicator is a law of nature. The past can illuminate behavior, but it cannot guarantee outcomes. People learn, regimes change, and sometimes the crowd refuses to repeat its old choreography. So we sit with the real lesson. When policy becomes unpredictable and narratives wobble, markets do what humans do under uncertainty. They reach for safety, even if safety is just selling what can be sold quickly. If you find yourself watching $60,000 like it is fate, pause. The deeper question is not where the bottom is. The deeper question is what kind of world makes so many people desperate for a bottom at all, and what you choose to hold when certainty becomes expensive. We are block-sonic. We don't predict the market. We read its memory. And if you're here right now, don't just watch. Talk to us in the chat. Share what you see, what you feel. The algorithm can't read silence. It only reads movement. Every message, every reaction, keeps this current alive. Subscribe, share, and let others join the signal. Together we turn insight into motion. A quiet name behind a loud Bitcoin bet in BlackRock's exchange-traded fund. You can feel it, can't you? A market built on transparency still attracts the oldest human instinct to move silently when the stakes are real. Today we watch a large Bitcoin position collide with a small, ordinary name, and the questions multiply. A shell company called Leroy Limited appeared in a single public filing, claiming a stake of about $436 million in BlackRock's shares Bitcoin Trust Exchange Traded Fund. It was the first time the entity showed up, and the only time. A Hong Kong address, a phone number, and then the crowd did what crowds always do when knowledge is scarce. It tried to fill the gap with stories. The filing listed a director named Zhang Hui. In China, that name carries the same anonymity as John Smith does in the West. So instead of clarifying anything, it created a fog you could almost touch. People searched for a unique identity inside a name designed by sheer probability to be shared. And the search didn't disappoint. More than 100 Shanghaos appeared as directors across different companies in the Hong Kong registry. Not one answer. Just a reminder that bureaucracy can catalog people without revealing them. Here's the first tension you should notice. When Bitcoin moves, we pretend the only mystery is price. But the deeper mystery is always ownership. Who is choosing to hold value outside the familiar rails, and why now? Speculation quickly formed around a single idea. Mainland Chinese capital might be reaching Bitcoin through offshore channels, using United States-listed spot Bitcoin exchange-traded funds. The logic is simple enough to attract believers. Capital controls on one side, liquid global instruments on the other. A bridge forms, and the mind calls it escape. Micro hook. If this were truly about hiding, why leave a trail at all? Even analysts who live inside these structures admitted the trail led nowhere. And that, too, is information. When experienced trackers cannot connect the dots, it usually means the dots were placed to satisfy rules, not to satisfy your curiosity. Then the story tightened. The listed Hong Kong address was visited. The directory did not show Leroy. It showed another occupant, Avecamore Advice Limited. And another detail mattered more than it first appeared. Leroy, the entity holding the exchange-traded fund shares, was not incorporated in Hong Kong. Now we are in the realm where modern finance becomes almost philosophical. Entities can be real in law and nearly absent in life. A mailbox can hold more capital than a factory. A suite number can be a costume. After attempts to reach someone failed, a spokesperson finally spoke. The message was controlled and minimal. The owner prefers to stay low profile. The position, they said, reflects personal investment conviction. And notice what that statement does. It doesn't answer the public's hunger. It reframes it. It says you are not entitled to the person, only to the fact that the person acted. But questions remain because the structure itself invites them. Who is Avecamore, and why does the address point there? Corporate filings offered a partial outline. Avecamore Advice was wholly owned by Avecamore Limited, an entity in the British Virgin Islands. And Hong Kong records showed Zhang Hui, tied to a mainland China passport prefix, as the only director of Avecamore Advice, which was incorporated in March 2025. Beyond that, public detail vanished again as if the paper trail walked into fog. Then came the most revealing line from the spokesperson. The owner of Leroy is also a director of Avecamore. The implication is quiet but heavy. Zhang Hui may not be a random label at all. Zhang Hui may be the hand. Micro hook. Is this a single investor wearing multiple legal masks, or a larger organization using one name as a public handle? The spokesperson would not go further. Private businesses, they said, do not disclose additional ownership details. And here we meet the design of the reporting system itself. These filings identify reporting managers, but they do not require the world to see the ultimate beneficial owner. Large investors routinely use multiple vehicles for custody, structuring, and privacy. Sometimes for protection, sometimes for strategy, sometimes simply because the system rewards complexity. So what does it mean in human terms? If it is capital flight, the story is about constraint, money seeking room to breathe, funds moving out of mainland China into offshore assets through Hong Kong, then into a United States-listed Bitcoin exchange-traded fund, to diversify beyond the reach of domestic controls. Not ideology, not romance. Just the oldest action in economics. Choosing the path with fewer gates. But it could also be something less dramatic and more institutional. L'Aurore might be one compartment inside a cluster of funds or a family office structure. And if that is true, the choice of a United States-listed product over a Hong Kong-listed alternative could be nothing more than cost and liquidity, speaking plainly. Deeper liquidity, lower friction. A better place to park large capital without paying unnecessary tolls. Either way, the lesson is not about one name. It is about how modern capital behaves when it wants Bitcoin exposure but not attention. It routes through entities, addresses, directors, and jurisdictions the way water routes through cracks, not to confuse you, but to reach the lowest resistance. And we end where we began, with a paradox you can sit with. Bitcoin was built to remove trusted intermediaries, yet the world still wraps it in layers of legal distance. So maybe the question is not who Zhang Hui is. Maybe the question is what kind of world makes privacy feel like a necessity the moment conviction becomes expensive. If you have your own theory, you already know where to place it. Bitcoin's rebound fades as software fear and private equity stress pulled both stocks and crypto lower. You watched a bounce appear, and for a moment it looked like relief. Then the market reminded us of something uncomfortable. A rebound can be nothing more than a pause where fear changes hands. In the United States morning session on Monday, Bitcoin tried to recover from a steep overnight sell-off. The recovery was modest and it didn't last. By around midday on the East Coast, Bitcoin traded near $65,400, still down roughly 35% over the prior 24 hours. Now ask yourself why the bounce couldn't breathe. Because the wider world of risk was sliding at the same time. United States equities fell sharply, with the Standard & Poor's 500 and the Nasdaq 100 each down more than 1%. The weakness wasn't random. It concentrated in the places that had been priced like certainty. Software and the private equity complex tied to it. Here is the first quiet contradiction. Software is supposed to be the stable layer of the modern economy. Recurring revenue, sticky users, predictable margin. Yet the iShares expanded tech software exchange-traded fund sank another 5% to a fresh 52-week low, and it was down nearly 35% since October. The story driving that drop is simple. Generative artificial intelligence might disrupt the old software business model. But the deeper story is about classification. What is Bitcoin in the mind of the crowd? Micro hook. When the market looks at Bitcoin, does it see money, or does it see a technology stock with a different costume? In recent trading, Bitcoin and that software gauge have moved almost in lockstep, nearly perfectly correlated. Whether that correlation is rational doesn't matter in the moment. Prices don't measure truth first. They measure positioning first. If the marginal seller treats crypto as software risk, then Bitcoin gets sold when software gets sold, even if the long-term thesis is entirely different. And then private equity enters the room, carrying a different kind of anxiety. There are continuing worries that artificial intelligence enthusiasm has pulled credit toward the edge of a negative event, something that rhymes with the global financial crisis of 2008. Private equity share prices have reflected that tension. partly because these firms are heavily exposed to the same software sector now being questioned. Blue Owl Capital, which sold assets last week to calm investors seeking liquidity, fell another 3.5% on Monday and was down 32% year-to-date. Blackstone, Ares Management, and Apollo Global Management extended recent losses, falling roughly between 6% and 8%. Micro hook. Do you see the pattern forming, the one markets repeat when easy stories meet hard funding? When liquidity becomes the concern, everything that depended on abundant liquidity gets repriced together. Crypto often trades as a high beta mirror of tech appetite and broader financial conditions. So Monday's weakness wasn't a mystery. It was the market admitting in real time that it is less confident about the future than it was priced to be. Bitcoin has held above the worst of its early February lows, but it remains boxed in a tight corridor, roughly between $60,000 and $70,000, because risk appetite is still delicate, not broken, just easily startled. And there's another layer of uncertainty hovering above it all: global tariffs. After the Supreme Court restricted President Trump's previous use of sweeping levies, traders were left to reprice what policy might look like next. Joel Kruger, a market strategist at LMAX Group, framed it as a classic risk-off shift, where investors retreat from speculation and Bitcoin behaves less like digital gold and more like a leveraged bet on sentiment. We can hold two truths at once. In the short run, the crowd trades Bitcoin as risk. In the long run, Bitcoin exists precisely because risk is what fiat systems manufacture through distortion and credit expansion. So we end here quietly, where the chart becomes a mirror. When fear rises, you learn what people truly believed Bitcoin was. And if you feel that tension in yourself, it's worth sitting with it long enough to name it. Because the name you choose changes the action you take next. We are Blocksonic. We don't predict the market. We read its memory. And if you're here right now, don't just watch. Talk to us in the chat. Share what you see, what you feel. The algorithm can't read silence. It only reads movement. Every message, every reaction keeps this current alive. Subscribe, share, and let others join this signal. Together, we turn insight into motion. To freeze or let it move. What quantum risk reveals about Satoshi and vulnerable Bitcoin? Quantum computing is not just a future machine we may build. It is a mirror held up to Bitcoin's oldest assumptions. And when we look closely, we find that millions of Bitcoin, including Satoshi Nakamoto's dormant fortune, sit at the intersection of cryptography, property, and the uncomfortable question of who gets to change the rules. You can feel the tension, can't you? Bitcoin was built to remove trusted hands, yet the moment a new kind of power appears, we instinctively reach for governance. Start with the simplest possibility. If quantum computers ever become capable of breaking the cryptography that protects Bitcoin keys, then coins tied to exposed public keys could be taken by whoever arrives first with that capability. And among the most symbolically loaded of those coins are the roughly 1 million Bitcoin attributed to Satoshi Nakamoto, resting untouched, like a sealed room in an old house. At a price near $67,600 per Bitcoin, that single stash implies about $67.6 billion in value. But we both know the number is not the point. The point is what that value represents: trust stored in math and time stored in silence. Now widen the frame. Some analysts estimate that roughly 6.98 million Bitcoin could be exposed in a sufficiently advanced quantum attack. At current prices, that is roughly $440 billion sitting behind locks that were designed for yesterday's tools, not tomorrow's ones. Here is our first micro hook. What happens when a system built on neutral rules meets an asymmetry of capability so extreme it looks like magic? The vulnerability is not evenly distributed. Early Bitcoin used a transaction style that placed public keys directly on-chain. Modern usage usually hides the public key behind a hash until you spend, which delays exposure. But if a public key was revealed through early mining patterns or repeated address reuse, that reveal cannot be undone. In a quantum scenario, the fear is simple. What was once computationally infeasible becomes feasible, and the past becomes an open door. And then the human part arrives, not the math, the choice. One camp looks at this and says freezing those coins would poison Bitcoin's neutrality. If the protocol begins to treat some unspent outputs differently because of age, identity, or perceived risk, then we have introduced a new category of power. Today it is protection. Tomorrow it is policy. Once the exception exists, the temptation to expand it is no longer theoretical. But there is a second problem that cuts even deeper. The network cannot reliably tell the difference between coins that are lost and coins that are simply quiet. Dormancy can be discipline. It can be death. From the protocol's perspective, both look identical. So any attempt to freeze lost coins is really a decision to freeze coins that merely failed to signal in the way we prefer. Here is our second micro hook. If we cannot know intent, what exactly are we freezing other than our own anxiety? So this side argues for a different path. Upgrade the cryptography. Offer quantum-resistant signatures. Let holders migrate voluntarily. Keep the ownership rules intact and strengthen the locks rather than changing who is allowed to own the house. Then we meet the harder, colder view. Private keys control coins. That is not a slogan. It is the operating principle. If quantum breakthroughs allow old coins to move again, even coins presumed lost, some argue that this is simply the world changing and the protocol remaining honest about its own rules. The market absorbs shocks. Any temporary inflation from previously inaccessible coins re-entering circulation becomes just another event priced into reality. Under that lens, code as law is not moral posturing. It is a refusal to pretend that fairness can be engineered after the fact. If the key can be derived, the coin can be spent. End of story. And yet another voice cuts through with a sharper edge. Freezing old addresses violates immutability and property rights, even if those addresses trace back to the earliest days. Coins from 2009 are protected by the same rules as coins mined today. If someone breaks the lock first, they claim what is inside. But notice what we are really arguing about. We are not debating quantum mechanics. We are debating legitimacy. Jameson Lopp frames the permissive approach as a massive wealth transfer to whoever gains access to advanced quantum hardware first, not to miners who secure the chain through ongoing cost, not to builders who coordinate commerce, but to a new class of actor who extracts value from historical exposure. In his view, a defensive change would not be confiscation, so much as burning vulnerable outputs, making them unspendable unless moved to safer addresses before a deadline. That would likely require a soft fork, and with it, broad social consensus. And this is where Bitcoin's real design shows itself. Not in code, but in coordination. Upgrades are not installed. They are agreed upon. Some technologists look at the whole debate and shrug. If a threat becomes real, you upgrade the cryptography. Engineering solves what engineering created. No romance, no theology. Others warn that the timeline may be shorter than we want to admit. Quantum research has suggested that fewer physical qubits than previously assumed might be needed to threaten widely used encryption systems, and that if certain results hold up, the path to breaking common standards could compress into a span as short as 2 to 3 years. Even if Bitcoin-specific cryptography is not identical to those targets, the direction of travel matters. Progress in fault-tolerant systems does not stay politely contained. Still, many believe we are far enough away that panic is irrational, that the practical threat is not imminent, that the community will adapt before the cliff arrives. So we end where we began, not with a machine, but with a choice. Freezing vulnerable coins challenges Bitcoin's immutability, the promise that rules do not bend for convenience. Allowing them to be swept challenges Bitcoin's sense of fairness, the intuition that wealth should not be redistributed by a sudden leap in technological dominance. And maybe that is the real lesson quantum computing brings to the surface. Bitcoin cannot escape human action. It can only constrain it. If this question stays with you, let it. Because the answer will not arrive as a headline or a decree. It will arrive as a collective willingness to pay a cost now to avoid a larger cost later. We are block sonic. We don't predict the market. We read its memory. And the memory's asking you something quietly. When the future finally tests the locks, will we defend the rules or the outcomes we grew comfortable with? When fear types Bitcoin to zero, America panics. The world shrugs. You can hear a market's emotions before you see them in price. This month, searches in the United States for Bitcoin collapsing to nothing reached their loudest point yet, right as Bitcoin slid towards $60,000 after falling more than 50% from its October peak. But when we widen the lens, the global mood is cooling, not escalating, and that contradiction matters. You notice the strange ritual, don't you? People rarely search for zero when they feel informed. They search for zero when they feel cornered. In February, in the United States, the phrase Bitcoin Zero surged to the top of Google's relative interest scale, reaching its maximum reading. It arrived as Bitcoin drifted down towards $60,000 after a drawdown of more than 50% from its October all-time high. Price fell, and the mind reached for an absolute word. Not lower, not lower, not risk. Zero. And yes, we understand why traders watch that kind of thing. When the crowd starts speaking in finalities, it can signal capitulation, the moment when selling stops being strategy and becomes emotional relief. In past cycles, similar bursts of Bitcoin as finished energy appeared near local lows, when exhaustion replaced conviction and the last weak hands let go. But here's the first tension we have to hold calmly. A signal can rhyme without repeating. The market is a pattern of humans, not a machine of guarantees. Now widen your view beyond the United States. Globally, that same search term did not set a new high this month. It peaked back in August at the maximum reading, then faded, falling into the 30s in February. So while the United States is shouting, the rest of the world is comparatively getting quieter. Ask yourself this micro question. If this were true universal panic, why would global fear be declining? That divergence tells us something simple and uncomfortable. The panic is not evenly distributed. It is local. And local fear usually has local stories attached to it. In recent weeks, the United States has been swimming in its own catalysts, escalating tariff talk, tensions involving Iran, and a broader rotation away from risk in domestic equities. When headlines press on a population's sense of stability, people don't just sell assets. They search for narratives that justify the feeling in their chest. Meanwhile, holders in Asia or Europe may be living inside a different news cycle, with different pressures, different priorities, and different thresholds for what feels like emergency. The same drawdown lands on different minds in different ways. Here's the second micro hook, and it matters more than it sounds. What if the number you are staring at is not what you think it measures? Google Trends does not show raw search volume. It shows relative intensity on a 0 to 100 scale, where 100 simply means the highest point for that term in the chosen window. So a 100 reading in February of 2026 does not automatically mean more total people searched than in the bear market years. It means interest spiked relative to its own baseline, and that baseline may be much higher now because the audience is larger. Bitcoin's visibility has expanded dramatically since 2021. More people know the word, more people react to it, more people use search as a coping mechanism. So the same 100 can represent a different reality depending on how wide the crowd has become. So what do we deduce together without pretending to predict? Retail fear in the United States is clearly elevated. That can become contrarian fuel, because markets often turn when certainty becomes theatrical. But the classic framework of search has hit a bottom. Therefore, price must reverse, loses force when the global trend is cooling, and when the measurement itself is relative, not absolute. And that leaves us in a quieter, more honest place. Not with a prophecy, but with a lens. If you find yourself tempted to treat a search spike as a clean map to the future, hold that impulse for a moment and examine it. Are we measuring the crowd's surrender or just the crowd's attention? And when attention grows larger every year, what does panic even mean anymore? Bitcoin feels like late 2022 again, and that should change how you wait. You can feel it, can't you? The market is quieter, but not calmer. And when Bitcoin stops shouting, that is often when the real decisions move from impulse to intention. Earlier this month, Bitcoin's sharp sell-off looked like chaos. But you and I know chaos in markets is rarely random. It is usually leverage being forced to confess. Vettel Lunda, who studies this behavior for K-theory, sees the aftermath not as a fresh disaster, but as something familiar. A late-stage bear market mood where price stops falling fast and starts testing your patience instead. He points your attention to late September and mid-November of 2022. Not because history repeats perfectly, but because human action rhymes under pressure. Back then, Bitcoin drifted between $15,000 and $20,000, far below the 2021 peak. It was not exciting. That was the point. The bottom was not a moment of celebration. It was a season of boredom. Now the range is different in dollars, but similar in psychology. Bitcoin has been settling between $65,000 and $70,000, and K33's regime model, built from derivatives behavior, exchange-traded fund flows, technical signals, and macro signals, suggests we are nearing a cyclical low, not a guarantee, a clue. The kind that only appears once the crowd has stopped demanding immediate relief. Here's the first tell. Activity dries up. When speculation has been burned off, there is less need to trade. The report notes spot volumes falling by 59% week over week. Perpetual futures open interest sliding to a 4-month low. Funding rates staying negative across the board. This is what a market looks like after forced liquidations have cleared the room and the survivors are counting what they lost. Ask yourself a simple question. If everyone is exhausted, who is left to sell in a panic? Lund frames this cool down as normal digestion after a liquidation cascade. Losses get absorbed. Positions get reset. The market stops acting like a stampede and starts acting like a negotiation between people with different time horizons. And then there is the exchange-traded fund layer, the institutional wrapper that many assumed would make Bitcoin behave more politely. United States-listed Bitcoin exchange traded funds have seen a record peak to trough decline in exposure of 103,113 Bitcoin since early October. Yet even after Bitcoin retraced by nearly 50%, more than 90% of that peak exposure remains in Bitcoin terms. In plain language, many of the new holders reduced risk, but they did not abandon the idea. So what does sentiment do when price stops rewarding emotion? It collapses. The crypto fear and greed index fell to an all-time low of 5 last week and stayed below 10 for most of this past week. That number is not magic. It is a mirror. It shows you how quickly conviction evaporates when the market stops offering easy validation. Second micro hook, and it matters. If fear is this loud, why is price no longer falling in the same way? Lund's deduction is restrained. Bitcoin is likely near or at a global bottom. But the next chapter may be prolonged consolidation, roughly between $60,000 and $75,000. Historically, regimes like this tend to deliver muted returns, which is another way of saying the market may not pay you for being early. It may only pay you for staying. And that is where the long-term investor appears, not as a hero, but as a person with a different relationship to time. Lund argues these levels can be attractive for accumulation, with one condition: you must be willing to endure the dullness without inventing a story to escape it. James Check, an on-chain analyst and co-founder of Check and Chain, puts it even more bluntly. Most of the time, Bitcoin does nothing. Then it reprices in bursts. The meaningful moves often compress into a small number of trading days, frequently early in a bull cycle and again later on. Miss that narrow window and you can spend months being right, while still missing the run. So the trap is obvious. People try to time the perfect bottom, and in doing so, they are absent for the first surge. They demand certainty before participation, but markets only reward those who accept uncertainty as the entry fee. We can sit with the uncomfortable conclusion: consolidation feels like punishment. Yet it is often the market's way of transferring Bitcoin from impatient hands to deliberate ones. If you find yourself rereading this idea later, it may be because some part of you recognizes the pattern. And maybe that is the real question we leave open together. When Bitcoin becomes quiet again, will you interpret the silence as weakness, or as the moment the market asks what your time is worth? Bitcoin ignores the tariff storm, drifts toward $68,000, while altcoins stir. You can almost feel the contradiction, can't you? Politics throws a new shock into the world, and yet price behaves as if it has already heard the story before. Today we watch Bitcoin and its neighbors absorb court rulings, new levies, and rising geopolitical tension, and still move with quiet indifference, as if the real signal is somewhere deeper than the headlines. You notice the first lesson immediately. Uncertainty does not always create panic. Sometimes it creates clarity. As the day opened, the highest court in the United States declared President Donald Trump's global tariff rollout illegal. A dramatic sentence on paper. But the market does not trade paper. It trades expectations. And then the ruling left a vital question hanging in the air. What becomes of the tariff revenue already collected, and what paths remain for the trade agenda to continue through other legal and executive doors? Here is our first micro hook. When a policy is called illegal, does it disappear or does it mutate? By afternoon, the mutation arrived. President Trump announced an additional 10% global tariff, framed under Section 122, designed to last roughly 5 months, and effective in 3 days. It was placed on top of existing tariffs, like another weight on a scale already loaded. And yet sentiment barely flinched. That is not because markets are brave. It is because markets are adaptive. When intervention becomes a recurring pattern, people stop reacting to the moral language and start pricing the mechanic. Traders do not need certainty about justice. They need a map of incentives. Risk assets moved modestly higher through the session, crypto included. A broad basket of major tokens rose by a small margin over the last 24 hours, with several large altcoins leading the bounce. Bitcoin itself hovered just below $68,000, as if the tariff noise was happening in another room. Second micro hook. What if the real volatility is not in price, but in the stories we tell ourselves about control? Traditional equities climbed too, with major United States indices posting measured gains. Crypto-linked equities followed, While certain Bitcoin miners tied to artificial intelligence infrastructure, narratives lagged and fell. Even inside the same sector, you can see the market separating dreams from cash flows and separating leverage from endurance. A trader described it as a small rally in risk assets after the tariff news, because the narrative forming is that tariffs damage the broader environment. But notice what that really means. The market is not celebrating tariffs. It is repositioning around second-order effects, around who bears the cost, and how quickly the cost shows up in earnings, in consumption, in credit conditions. Still, conviction remains thin. Price can rise without belief, just as a crowd can move without agreement. Trading volumes are muted, and when participation is quiet, ranges become cages. Without a new shock or a new permission structure, crypto may continue to drift sideways, not because nothing matters, but because everyone is waiting to see which risk becomes unavoidable. And one risk sits outside the tariff theater entirely: the possibility of strikes against Iran in the coming days, after weeks of military buildup in the region. That is the kind of event that does not ask your opinion before it changes your portfolio. It arrives as reality, then forces repricing. So we end where we began, together in the same tension. Courts can speak. Presidents can announce. But markets listen for something else. The durability of incentives. The scarcity of real savings. And the limits of what can be managed from above. If you felt the strange calm in today's price action, hold that feeling. It might be worth remembering the next time a headline demands your fear. Because the question is not whether tariffs are legal or illegal. The question is what you and I do when the world keeps proving that control is always smaller than it sounds. Bitcoin rises, then retreats as the Supreme Court limits Trump tariffs. You felt that quick lift in Bitcoin, didn't you? A flash of relief, then the familiar hand of selling. We are watching a market that reacts instantly to power being constrained, and then remembers it still lives inside uncertainty. The Supreme Court struck down President Trump's tariff regime in a 6-3 decision, and the language matters because it reveals a boundary. The court points to something simple. No president had used that statute this way before, not for tariffs of this size, not with this reach. And when an authority claims a power with no living precedent, the market hears a different message than politics intends. It hears fragility. It hears that rules are not as settled as yesterday pretended. Bitcoin responded the way reflexes respond. It jumped about 2%, pushing beyond $68,000, as if the world had become slightly more legible. Then, within minutes, it gave it back, sliding to just below $67,000, as if to confess, we do not trust the calm yet. Here is the first quiet paradox. If Bitcoin is built for a world of policy risk, why does it still flinch at policy headlines? Because even sovereign money is held by humans, and humans carry time preference in their hands. They reach for certainty, then they sell it, then they miss it. Mid-hook. What if that sell-off is not weakness, but a measurement of how many people still treat Bitcoin as a trade instead of a savings technology? While Bitcoin's move evaporated, stocks look steadier. The Nasdaq pushed higher by about 0.6%, holding its gains more convincingly. And that contrast tells you something uncomfortable. The market still believes the traditional system will be supported, even when the data starts to argue otherwise. Earlier in the day, economic numbers carried the scent of stagflation. Growth slowed. Prices stayed stubborn. The economy expanded only 1.4% in the final 3 months of 2025, while core personal consumer expenditure prices rose 3% year over year, hotter than expected and higher than before. On an annual basis, growth came in at 2.2%, the slowest since the COVID year 2020. Slow output, persistent inflation, not a dramatic collapse. something more draining than collapse. A long erosion of purchasing power paired with fading momentum. A strategist summarized it plainly. Inflation hotter than expected. Growth slower than anticipated. And that confusion reinforces the central bank's bias to wait. But waiting is not neutral. In a world where money is managed, delay is a choice with winners and losers. Mid-hook, when the signal is messy, do you notice what people really buy? Assets that depend on policy rescue or assets that ask you to rescue yourself? So we end up here with a court drawing a line around executive reach, with markets trying to translate law into future cash flows, and with Bitcoin doing what it often does in moments like this. It tells the truth too quickly for comfort, then watches the crowd argue with it. If you sit with this for a moment, you can feel the deeper pattern. Every institution seeks room to act. Every trader seeks an exit. Every saver seeks a money that does not require permission. And the question lingering under the price is not whether Bitcoin popped or dropped. It is whether we are finally ready to stop treating stability as something authorities can declare and start treating it as something we build through sound choices and real savings. If this tension feels familiar to you, it may be worth keeping close, because it will return in new disguises. Thank you for staying with us through the noise, the charts, the truth. You are part of this signal now. We'll be back soon with more stories, more logic, more discovery. Until then, keep your eyes on Bitcoin and your ears tuned to the sound of freedom that never stops playing. This is Block Sonic.